Hey everyone, and welcome. Today we're going to unlock one of the most powerful and, surprisingly simple concepts in all of finance. We're going to break down exactly what the S&P 500 is, and more importantly, why so many people see it as a cornerstone for building real long-term wealth. But first, let's just kick things off with a big question. How can you possibly take the pulse of an economy as huge and complicated as the United States? Is there really one single number that can give us a pretty good idea of what's going on? Well, it turns out there kind of is, and that's exactly what we're about to dive into. So let's get right to it. What exactly is this thing called the S&P 500? You hear the name thrown around all the time on the news, right? But really understanding what it represents? Well, that's the first step to unlocking its power. Okay, so at its most basic level, the Standard & Poor's 500 is just a stock market index. But honestly, it's so much more than just a list. A better way to think of it is like a snapshot, a single picture that captures the health and performance of 500 of the biggest and most influential companies in America. Seriously, when you hear someone say, the market is up today, chances are they're talking about the S&P 500. And who's actually in this exclusive club? Oh, just the titans of industry. We're talking about companies you probably interact with every single day. Think Apple, Microsoft, Amazon, Nvidia, and Alphabet, which, of course, is the parent company of Google. The sheer size of these companies means this index isn't just a number. It's practically a reflection of our modern world. Now, this is where it gets really interesting. How has this index stayed so relevant and so powerful for decades, through all the booms and busts? Well, it has this kind of built-in secret, a secret to what you could almost call financial immortality. This right here, this illustrates its core strength perfectly. See, the index isn't static. It's a dynamic, self-regulating engine. When one of those 500 companies starts to struggle and weaken, it gets automatically kicked out. And then a new, stronger, up-and-coming company takes its place. This constant refreshment process is absolutely key. It ensures the index is always representing the top players, automatically weeding out the laggards and promoting the leaders. It's always looking forward. So we know what it is, and we know why it's so incredibly resilient. But what does any of this actually mean for you? Okay, let's break down how this whole concept translates into a powerful but simple formula for your financial future. This one number, this is the heart of the whole thing. About 10%. Historically, if you look back over the last, say, 50 to 70 years, the S&P 500 has delivered an average annual return of around 10%. Now look, is it 10% every single year? No, of course not. Some years are way up, some are down, but that long-term average, that is an incredibly powerful engine for growth. And the force that absolutely supercharges that 10% average? It's compound interest. You've probably heard of it. It's basically your money making money, and then that money starts making its own money. It's like a snowball rolling downhill. It starts small, but over time, it can grow into this unstoppable force for building wealth. Okay, so you're probably thinking, this sounds great, but how do I actually buy a piece of the S&P 500? How do I do this? Let's get into the practical side of things and see how you can go from just understanding this stuff to actually participating in its growth. Right, so here's the thing you absolutely have to know. You can't just go out and buy the S&P 500. It's not a thing you can buy. It's just a list, a measurement. So instead, what you do is invest in a special kind of fund that does all the work for you. These are called exchange-traded funds, or ETFs, and they're designed to perfectly mirror the index because they hold all 500 of those stocks for you. And there are three really popular options that all do the same basic job. You've got VOO from Vanguard. Its main claim to fame? Super, super low fees, which means more of your money is actually working for you. Then there's SPY, which is the most traded. That just means it has the highest liquidity, making it incredibly easy to buy and sell. And finally, IVV is another fantastic, low-cost favorite, really popular for people who are in it for the long haul. All right, so now you know what you can buy. But the next question is, how should you go about it? Let's talk about what is widely considered the single best strategy for beginners, a simple approach that takes all the stress and guesswork out of investing. And that strategy is called dollar cost averaging, or DCA for short. It's a beautifully simple idea. All it means is that you invest a fixed amount of money, let's say $100, at a regular interval, like every single month. And you do it no matter what the market is doing. Whether it's up, down, or sideways, you just stick to the plan. So, choosing a strategy is really about taking emotion out of the equation. On one path, you've got DCA. It's disciplined, it's automatic, it's unemotional, and it reduces your risk over the long run. On the other path, you have trying to time the market, guessing the perfect time to buy low and sell high. And let me tell you, that path is stressful, emotional, and for most people, it's just a recipe for making costly mistakes. DCA is all about consistency, not about trying to predict the future. And all of this brings us to our final thought. We've taken apart the S&P 500, we've seen how it works, and we've looked at a simple strategy like DCA that can put its power right in your hands. So the final question isn't really about the market, it's about you. What role will that unstoppable engine of compound interest play in your future?